Talk about all of the current updates we got as far as the conflict with Iran and Israel. We'll talk about a Fed member who thinks it's appropriate to cut rates pretty soon. We'll talk about how stocks are reacting to all of this mess going on, and then economic data we've gotten today and what to look forward to next week. Hope this video is valuable. Thank you for hanging out with me, and come learn with me anytime. So far today marks the 8th day of this Middle Eastern mess going on. Today there was a meeting in Geneva with Iran and some European officials. We had France out there, the UK, Germany, EU, all to see what they can do to try to de-escalate this conflict. But all agree with the US that no nukes for Iran, right? Nobody wants them to have these nuclear weapons. And this meeting that they had in Geneva pretty much ended out to failing to reach an agreement. So today's off the table pretty much. We're gonna hope that they can reach an agreement pretty soon. But Trump was asked if he'd bomb or strike the Iran, and what we've found is that he's going to use his common game plan he uses for negotiations by giving a deadline. And what he's saying is, hey, I'd wait 2 weeks, let's give them some time to negotiate, see if they can reach a deal, and in 2 weeks I'll go from there on whether the US needs to get involved or not. And I'd say this is Trump's primary approach to pretty much everything so far. Think about it, with TikTok and with all of these tariffs with other countries, he'll pretty much set this deadline and kind of just kick his feet back and put his arms up in the chair and just wait. And then as we get closer, there's that deadline effect that kicks in. But if an agreement's not reached, do we really see that happening? Do we really see a possible conflict with the US actually striking another country? That may not actually turn out well, and especially when it's one of China's and really global oil. And we'll talk about this, but China gets really cheap oil from Iran. So if something were to happen and oil was halted, China could pick a side, and that could be a problem. Now, oil is a big mover to watch. We want to make sure that we're not getting into this more inflationary period to where oil prices are surging and causing more problems than need to be. So although oil has surged, it hasn't really got to the point to where it's a big problem, just because it's considered a fair price from where it could be versus last year. Let's see where we were at last year. So yeah, if you look at these charts, like, it's not too far off. Like, look at 2014, how high we were back then. 2022, we've seen a spike. Kind of looking at some of these different charts just to see how they've really performed over time. But yeah, I mean, overall, it's not like we're at $120, $140 a barrel for oil yet. So assuming we don't get to those type of levels again, it should be good, and history shows that these concerns are usually more overblown than need to be. I think the main worry right now is watching this Strait of Hormuz, just because if that was halted, this, like I said, that's a very important strait for the trade of global oil, which accounts for about 3% of the total supply of global trade as far as oil goes. So some see that if that was halted or something happened there to where oil isn't easily tradable, that could be a problem, and that's where these supply shocks and inflation impacts really come to fruition. Now, I also read this article that was talking about that the US could see that as an act of war if anything ever happened, as far as Iran refusing to send out oil. So we'll just go from there and kind of watch. But a supply shock that would surge prices, leading to more inflation, that's not really what everybody wants right now, and especially as the Fed already has this forecast of a possible stagflationary environment later on this year. So as long as oil stays below $100 a barrel, there's this belief that this is just another nothing burger according to history. The past doesn't often repeat itself, but it rhymes sometimes. Now, same with stocks. Everybody's really watching with what's going to happen with these stocks, and let's pull up a few of them. Let's pull up I'll pull up a S&P 500, we'll pull up the NASDAQ 100, could look at the Dow. And I mean, let's pull up Bitcoin just to have that up. I know that's not a stock, but some people say it's like a leverage NASDAQ, pretty much. CUSD, boom. And yeah, we're on a much larger chart than I'd like to see, but I think this is relevant because some people, wow, these charts all look almost the same. We got the S&P 500. We got the NASDAQ 100. So top 500 companies, then top 100 companies, then the Dow Jones. Just kind of think of that as more of like your value play, and then you got your Bitcoin, more your riskier play. And what some people, the same with oil that we were just kind of talking about, how these geopolitical events are more overblown. There were a ton of articles when this conflict broke out 8 days ago as to whether this was a buy the dip opportunity or not. And what history shows is that usually it is. Now, assuming that oil doesn't go to those much higher levels we were just talking about, like the $120, $140 barrels, we might be all right. But if they do, that's where the conflict grows, and that's where a much larger issue can occur, to where people are scared away from these riskier assets, hence the stock market, cryptocurrency, and looking for more your safety plays like treasuries, maybe even treasuries from other countries other than the US, gold, maybe even the dollar. Everything, there's a lot of different factors going on. So within that 2-week deadline, we may or may not see an agreement made by Iran and Israel. That's what a lot of people are hoping for and would like. But does this taco trade come back into play? And remember what the taco trade stands for. Trump always chickens out. So does it get to the point to where at this 2-week end and there's not a deal made, and then it's like the TikTok banning or the tariffs going up to a crazy high extent? Does that can just get kicked down the road? Maybe he extends it like everything else. Maybe not. We don't know that. That man's the wild card. And that's kind of where he comes in with this. But with this being an issue in relation to nuclear weapons, some are more sketched than others about these stocks at these levels, like turning their nose to all of this mess going on. So a lot of people are more nervous about this situation versus negotiating tariffs with China or the European Union or any of these other problems kind of going on right now. So with an agreement not being reached, that could be a problem, but usually history has showed, just like what we were just talking about with oil and everything, is this a buy the dip opportunity? We don't know that. It just kind of depends on whether or not people think it could escalate. So on the day, stocks were pretty mixed. I was watching and kind of trading today. I had a really good day starting off, and then I kind of got smacked later into the day, and then I pulled myself back out of the grave with it. But yeah, so the S&P 500 ended out a little negative for today. So did QQQ, the NASDAQ 100. We also seen Bitcoin ended out, but it looks like in the after hours, most of these except Bitcoin are a little bit more positive, maybe just kind of buying the dip after the day. But I'd imagine this sell-off today was due to maybe this time's different. Maybe we shouldn't buy the dip, and maybe it is going to get worse, because if they really don't want Iran to have a nuclear weapon, what could they do with a nuclear weapon? So that's kind of serious. So I might just, just kind of take some of the risk off the table. But I mean, there's hope. Like a deal could be reached, especially with this 2-week extension. We got pretty much a ticket for 2 weeks of nothing's going to get worse involving the U.S. picking a side, which would be Israel against Iran, and then other countries picking sides, and that turning into a much larger fight. Like you and your homies get into a fight, and then that person's homies get into the fight, and then it's just a big old mess of homies fighting. We don't want that. So this 2-week extension pretty much is good news, but we don't know what could happen when we get there. Now, there are other issues brewing that can impact the market reacting these new highs that we've been chasing, hoping to reach again. We are just kind of looking at that on those longer term charts. If you don't remember, just rewind a couple seconds. But we got a report from UBS, and what UBS was pointing out is that there are some concerns in this market. So a team of strategists at UBS led by Sean Simmons reckon it's too early to sound the all clear for stocks to, I'd imagine, reach a new high. In a note published Friday, they say a batch of signals they observe suggest the US economy is in a slowdown regime, though. The inflection is so shallow we just don't know if it's a real turn lower yet or not. And with these stocks being at a higher high, they're pointing out that stocks are a little bit more, what's the word he used? Have been quite meek compared. The problem is that any further economic deterioration would hit a stock market that is now vulnerable to bad news, is how they put it, after its recent strong rally from April lows. So you got to remember, we were at all-time highs back in February. And then we got the Liberation Day tariffs. Oh my gosh, that's way worse than we were all expecting. Sell, 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 sell. And then it's like everybody's trying to get out so they're not the one left holding the bag. And we've seen this temporary correction in the markets, but then since then they've pretty much climbed all the way back up and we're testing new all-time highs yet again. And with us being at these all-time highs, they're saying over there at UBS that the stock market is now vulnerable to bad news after its recent strong rally. And they just kind of point out that the economy is slowing down. Where do they put that? The current relative optimism about corporate profits would be badly damaged were the economy to deteriorate further. They note that the analysts are predicting sales growth for 2025 of 5% and earnings per share growth near 10%. We do expect these will continue to slide for the remainder of the year on weaker economic data and hard data too. They also point out concerns for valuations. The S&P's 500 is expensive on a forward PE of 22 times with slowing growth expectations. Though the strategists acknowledge that the resilience of the AI sector may help justify it for now. So maybe companies start adopting AI and it really helps them maybe juicing up their margins a bit, even in the case of slower spending from consumers. And if you think about it, companies could start laying off due to AI or just hiring less. And as that time as time goes on, people get more savvy with AI and people are able to work and do more work with AI, helping companies spend less money on, say, labor or goods. In that case, they get more efficient. They also point out that they expect that buybacks and constant flows from global pension funds will support stocks and mitigate the impact of selling if economic conditions do deteriorate. So they're not saying that a big old stock market's going to crash. A big old stock market crash is coming, but there are these vulnerabilities to pay attention to along the lines of these valuations, earnings growth, and then the macro economy setup. So with so many people suspicious, it makes sense that you'd want to kind of get away from riskier plays. And a risky play, I just said it wasn't necessarily a stock, but Bitcoin, which some look at as a leveraged QQQ, NASDAQ 100. Now, with cryptocurrency being where it's at and Bitcoin becoming very, very popular to where it even holds this digital gold theme or this leveraged NASDAQ 100 theme, many investors want to get away from Bitcoin and some are exposed to it kind of whether or not they like it. So just consider this as you start considering your allocations and the amount of risk you're taking on, because a lot of people don't realize they're leveraged to risky assets whether or not they believe it or not. So they think. In this article they talk about how people are exposed to Bitcoin, and it was a report from JP Morgan, and as much as 50 billion, where'd they put it? A new research from JP Morgan finds as much as 50 billion is invested in MicroStrategy, an IT company turned Bitcoin holder, in an indirect way. And it pretty much just goes on to say that, hey, these funds right here all have an allocation to MicroStrategy. And MicroStrategy's whole business model as of lately has been raising money to buy Bitcoin. So they're very leveraged to buy Bitcoin, and so far it's been performing very well. But in the case that Bitcoin sees some type of correction, it could systemically impact the entire market just because there are so many different ties. Where's that little chart at? Oh, wrong one. Yeah, right here. You got the NASDAQ 100. You got the Russell 1000 value index. You got the Russell 3000. You got the Russell 1000 index, the NASDAQ composite index. I'm pretty sure MicroStrategy's in the S&P 500 too. You might fact check me on that one. But if that stock sees some type of correction, it could move the market. It might not, like, if MicroStrategy's down 20% or something, it's not going to have the NASDAQ 100 down 20%, but it will for sure move mountains, so to say. So just consider your risk and where things are allocated. Some people are even getting away from US assets altogether. There's still that sell America, buy other assets trade thing going on. So taking some risk off the table wouldn't necessarily be a bad idea right now, and especially considering what Powell described as a very foggy time to make any forecasts. So the Fed sees this slowing economy, and they see this slowing economy on the horizon, while at the same time there's this Trump tariff effect, which is inflation inducing. So, and consider this is before the war was really going on that could impact oil prices. So just consider that. So what we got right here is from the Fed. They released the monetary policy report for June 2025. And if we get a quick look at their summary right here, they're pretty much warning from the Fed that we could be facing stagflation over as time goes by. So let's look at this together. So their summary is that inflation is continued to moderate this year, though it remains somewhat elevated. The labor market is in a solid shape, with a moderate pace of job gains so far this year and the unemployment rate at a low level. I wonder if they're considering the fact that college graduates are having a tough time finding jobs right now, and that the college graduate unemployment rate is at 7%. Although growth in real gross domestic product, GDP, is reported to have paused in the first quarter, growth in private domestic final demand was moderate, reflecting a modest increase in consumer spending and a jump in capital spending. However, measures of household and business sentiment have declined this year amid concerns about the effects of higher tariffs on inflation and employment, as well heightened uncertainty about the economic outlook. With the labor market at a near maximum employment and inflation continuing to moderate, the FOMC has held their maintained their target range of the federal funds effective rate at 4.25% to 4.5%. So they're pretty much warning that they see stagflation down the horizon. And real quick, let's just look at these stagflation mean. And what does stagflation mean? We've covered this before, but just for the sake of it. We like simple terms. Let's see what the simple terms look like. Stagflation is an economic term describing a situation where the economy experiences both high inflation, which is the rate of rising prices being higher, and slow economic growth, or even a recession. So even a recession during high inflation rates. And remember, that puts the Fed at a weird spot, because if they're expecting high inflation, they got to pick which fight they want. Hey, do we still want to keep fighting this inflation even though the economy is just in a slump and people are doing bad? Are they going to keep rates high in that case, or are they going to have to temporarily shift their focus and maybe bail out some companies and some consumers that lost their jobs? So it's all dependent on really what this job market is doing, and so far they're saying it's holding up. It just kind of depends on where you're looking, but that's kind of what we've got from this monetary report. I mean, you could go through this. This is 81, 91 pages or something, but that's interesting. And we also got some more from the Federal Reserve today. So we had Fed Governor Christopher Waller come out, and he was talking, and what we heard from him is that Christopher Waller supports the Fed looking past the impact of these tariffs with the inflation. He thinks that it's just kind of blow over, and he supports a rate cut in July. While these other Fed members may not agree with him, it'll probably be a H nah from everybody else. But I just thought it was interesting that he's one who supports July cuts. But his argument is that inflation is showing signs of cooling and that it shouldn't be ignored. And pretty much his approach is, hey, inflation's been cooling. Yeah, inflation might rise a little bit from these tariffs, but that's going to be temporary. Let's cut next meeting. Trump's already telling us we need to cut anyways, and he's trolling Jerome Powell and always on Truth Social. I'm pretty sure he made a Truth Social post about it today. But hey, let's go ahead and cut maybe a quarter, and then we could go from there. We could pause the next meeting, or we could cut again. But let's just cut now and then go from there, rather than being late. And then Jerome Powell's completely different, because his approach is, hey, let's wait and kind of let the dust settle more and let more economic data come in. And I mean, we like nothing's stopping us from waiting, and then cutting 1% or 2, and then we'll go from there. So that's kind of where we're at from the Fed. And just real quick, I wanted to see what the current expectations or odds are of a cut at the next meeting in July. So July 30th meeting, I mean, it didn't really move the needle, so to say, because it's still pretty much expected that they're going to keep rates the same at July's meeting. But let's see about September. So 16.5% that they cut at July's meeting. I'd imagine it's still probably no. The market's been expecting. Whoa, all right. So 60% for September. So we're holding over that 60%. I remember watching this for the longest, and it was at 50. 50, it went below 50 for a little bit, and then it was like high, mid 50s, back low. So, all right, we're holding over 60%. I mean, it's right there though, but all right, so that's kind of where we're at with that. We also got some US leading indicators data, and what this really does is provide clues about the direction of the economy. Now, on the website, it defines the leading economic index as providing an early indication of significant turning points in the business cycle and where the economy is headed in the near term. The coincident economic index provides an indication of the current state of the economy, and then it goes into the data. So this is what we got as far as the data. The Conference Board leading economic index for May, it kind of dimmed down to by 0.1% in May, going to this 99, and 99's below 100. So below 100 goes from pretty much, so above 100, I guess to put it, when it's over 100, this leading economic index, the LEI, when that is above 100, that is signs of an expansionary economy. Below 100 is contracting. So we're expecting a contraction. I mean, it's barely below 100 though, so it's not like way below. The LEI of the US fell again in May, but only marginally, they said. The recovery of stock prices after the April drop was the main positive contributor to the index. However, the consumer's pessimism, persistently weak new orders in manufacturing, a second consecutive month of rising initial claims for unemployment insurance, so those US jobless claims we look at, and a decline in housing permits weighed on the index, leading to May's overall decline. Then we got the coincident economic index, which inched up 0.1%, and that one is at 115, so it's over 100. That'll be your more expansionary view. The SEI's 4 component indicators: payroll employment, personal income less transfer payments, manufacturing and trade sales, and industrial production are included among the data used to determine recessions in the US. Industrial production was the weakest contributor to the index in May and the only SEI component declining. So, just real quick, what did it say the SEI stood for? So, the current state of the economy. So, forward looking, what we got from this data today is that looking forward, people are getting a little bit more sketch about where the economy possibly is heading, but currently the economy is still expanding according to this US economic indicator data that we're looking at. Now, let me just double check that there's nothing else that is going on so far. Let's look at some latest news. You know what? I like Market Watch a little bit more. Any new news come out, Mr. Market Watch? Nah, looks like we're up to date. So, what about next week? So, that's today. Today's Friday. It's the end of the week. Short week, too. Next week, we got US Services PMI. More data on how services are holding up. Existing home sales. S&P Case-Shiller Home Price Index. That one will be an interesting one. So, mark your calendar for Tuesday for sure. Consumer confidence. We'll have Fed Chair testifying for over the Financial Service Committee. New home sales on Wednesday. Thursday, we got the trade balance in U.S. goods, advanced retail inventories, wholesale inventories, more initial jobless claims for this week, durable goods orders, GDP, the second revision. All right, so Thursday is going to be a very important day. We'll get some Fed speak, pending home sales. Yeah, Thursday is going to be a busy day next week. This isn't even considering any earnings or anything coming out. So we'll be watching Thursday. I mean, I'm going to be here every day this week, so for sure come back and hang out with me so we could continue learning together. But on Friday, we got more consumer sentiment, personal income, spending, PCE. So PCE, for sure mark your calendar for Friday because PCE is the Fed's preferred gauge to measure inflation. And where are we expecting this one to come in at? So, all right, a match from last week. So we're expecting it to come in at just 0.1 for the PCE. Now, year over year, we're expecting it to come in a little hot. Yeah, so even for core PCE, up a little bit more. All right. And maybe they're considering, just kind of some seasonal spending to come in, maybe some Trump's tariffs front running effect, kind of boosting this inflation data coming in. So y'all, that's pretty much what we got. Let's check the Wall Street Journal, see if any new news came out, and I think we're gonna get wrapped up for the day. I appreciate y'all hanging out with me, learning together. I didn't have quite very many people on this one commenting and going back and forth, so maybe next time. I always appreciate when y'all come out and hang with me. But yeah, I mean, pretty quiet day aside all this other stuff we discussed in this video, but I'm always happy to come here and look through it anyways and share what I've taken away. So hope your day's amazing. I hope your weekend is a blast, and let's get ready for next week. I'll be back to cover everything going on and have a blast. Yeah, have a